Welcome to Morning Mortgages, where we discuss the mortgage rates of today. In this video, we will look at the current mortgage rates, their cause, and how they affect you through the use of real-world examples. Stick around to learn more. We will start by looking at the 7 most common types of mortgages ranked by current mortgage rates. Number 7, 30-year fixed. Like last week, the 30-year fixed mortgage remains in last place. The 30-year fixed loan is the most common loan, with all mortgage payments equally split across 360 months. When most people think of a mortgage, they think of the 30-year fixed mortgage. Today's 30-year fixed mortgage rate is 5.85%. Number 6, 30-year USDA. Falling one place from last week is the 30-year USDA mortgage. A mortgage sponsored by the U.S. Department of Agriculture, or USDA mortgage for short, is available to those that have a low to moderate income and are looking for a primary residence in USDA-approved rural areas. It offers a no down payment option. Today's rate for a 30-year USDA mortgage is 5.598%. Number 5, 30-year VA loan. Rising one spot from last week is the 30-year VA mortgage. A VA mortgage is available to veterans, military members, and qualifying surviving spouses. The VA mortgage has a monetary limit that is determined by the borrower and the property's location. A significant advantage of a VA mortgage is that it normally allows for a no down payment. Today's rate for a 30-year VA mortgage is 5.50%. Number 4, falling 2 whole spots from last week is the 5/1 ARM loan. A 5/1 adjustable rate mortgage, or ARM, is a mortgage with a fixed rate for the first 5 years, after which the interest rate fluctuates with the market and other conditions once a year thereafter. This may result in an increase or a decrease in monthly payments. When interest rates increase after the fixed rate period expires, many borrowers choose to refinance the ARM mortgage in order to obtain a lower mortgage rate. Today's rate for a 5/1 ARM loan is 5.34%. We have a tie for second place this week, with the 30-year FHA mortgage being one of them. A mortgage sponsored by the Federal Housing Administration is a government-backed loan that enables individuals to borrow money with looser financial requirements. Individuals with higher than average debt-to-income ratio or lower than average credit score, for example, may be eligible. Today's rate for a 30-year FHA mortgage is 5.25%. The other mortgage to tie for second place this week is the 15-year fixed mortgage. A 15-year fixed mortgage has half the lifespan of a 30-year fixed mortgage, with payments spreading equally over 180 months. A 15-year fixed loan is an option for those who want to pay extra each month to pay off their mortgage faster. Rates are often lower than those of a 30-year fixed mortgage because of the shorter duration. The current rate on a 15-year fixed mortgage is 5.25%. Number 1, 30-year jumbo. The 30-year jumbo mortgage remains the mortgage with the lowest interest. A jumbo mortgage is a mortgage for house buyers whose purchase price exceeds a price threshold. Currently, a jumbo loan is for a property worth more than $647,200 in most locations, with certain exclusions dependent on geography. A jumbo loan may be either an adjustable rate mortgage or a fixed rate mortgage. Today's rate for a 30-year jumbo mortgage is 5% on the dot. As the summary table shows, a 30-year jumbo loan remains as the lowest interest rate for those who can afford a house that satisfies the price threshold. Tied for second are the 15-year fixed loan and the 30-year FHA loan. The 15-year fixed mortgage is ranked third. However, since the repayment period is cut in half, 15-year fixed loans have a higher monthly payment. The 5/1 ARM comes in fourth. Bear in mind that after 5 years, such loans have a variable interest rate, which means the rate may fluctuate in the future. The 30-year VA loan is ranked 5th, and it is only available to veterans, service members, and qualified surviving spouses. The USDA loan ranks 6th, with financial and geographic requirements established by the U.S. Department of Agriculture. The 30-year fixed mortgage ranks last. This is the most common type of mortgage that borrowers obtain. Let's now look at what causes today's mortgage rates. As we remember last week, in anticipation of the Federal Reserve's policy announcement, mortgage rates skyrocketed into the 6% range. Homebuyers hoped that those mortgage rates would be the highest of the year, and it appears that their hopes will be realized. The mortgage rate trends this week has been a steady decline. The question is, why is this the situation? Mortgages are essentially converted into bonds, and these bonds dictate the interest rates that lenders can charge. Depending on the interest rates of the underlying loans, only certain bonds can contain mortgages. For example, one of these bonds can accept loans with rates between 5.25 and 6.125%. Thus, the value of a 6.25% loan would be determined by the bond with the next higher yield. If investors place a premium on the lower bond, as they might in an environment where there is hope that interest rates have peaked, a lender can make more money selling a loan with a rate of 6.125% than one with a rate of 6.25%. From here, we can continue to hope that the Federal Reserve's response to inflation and inflationary measures peaked last week. Unless a new narrative gains traction, this peak should coincide with an interest rate peak. However, this is only true so long as economic data confirms that inflation is leveling off. Several economic reports contributed to this notion this week, with Friday's decline in consumer inflation expectations being the most notable. Previously, Purchasing Manager data indicated decelerating prices and slower growth, both good for rates. Now, what effect did today's mortgage rates have on you? To answer that, let's consider 3 real-world examples of 3 hypothetical mortgages based on the median price of a house in the United States, which is now about $425,000. We will look at a mortgage for a property that is below the median, a mortgage for a property that is in the middle, and a mortgage for a property that is higher than the median. We will choose a 30-year fixed mortgage for the 3 scenarios since it is the most common type of mortgage and because it has the highest, meaning worst, rate of today's analysis. We will assume there is no down payment just to keep the mortgage amount equal to the property amount for simplicity's sake. As we can see, without accounting for expenses such as insurance, taxes, and homeowners association dues, the total cost for a $200,000 property at today's mortgage rate is about $1,180. In total, this would equate to about $10,000 less in payments compared to last week's rates. For a property with a value of $425,000, the total payment at today's mortgage rate is about $2,500. This would result in about $20,000 less than last week's rates. For a property with a value of $600,000, the total payment at today's mortgage rate is about $3,540. In total, this would mean about $25,000 less in payments than last week's rates. That is a lot of savings in just 1 week's time. Thank you for watching, and we'll see you next time at Morning Mortgages.